Hi everyone, welcome back to HLS. Today I am going to discuss the final component of determining the transaction price, that is payment to customers or consideration payable to customer. You might wonder what is this? Actually the customer has to pay for the entity, but why the entity pays for the customer? The business transaction happens in so many ways that interaction between the customer and entity happens continuously. For example, it can be a payment for a goods and services supplied by the customer to the entity. Entity also supplies goods, customer also supplies goods. For example, if it's a computer manufacturing company, the entity A, if it is a computer manufacturing company, supplies computers, laptops to the customer. At the same time, customer is manufacturing or selling motherboards. He will be supplying motherboards to the entity. So there are transactions as a seller and as a buyer, both ways. So these transactions can result in payment to the customer by the entity. Then there are other ways of doing it. It need not be a cash transaction always. It can be coupons or vouchers. A manufacturer will sell the goods to retailer. Retailer is the customer. The end customer buys from the retailer, the customer's customer. The manufacturing company goes and issues coupons to the end customer. So the end customer comes and get the reduction from the retailer. So the retailer has to be subsidized or reimbursed by the manufacturer. Then also the payment to the customer happens. There are so many ways it happens. Buy one, get one free. In hotel industry, stay 2 nights, 1 night free. So many options, so many transactions, so many dealings. It can happen. But eventually, there will be a payment to the customer. So we can categorize this to simplify. This is actually a confusing topic for the students. It's a confusing topic. So I have simplified that. So to simplify, the standards, first of all, what the standard says about the payment to the customer. I will read it. Consideration payable to a customer includes cash amounts that the entity pays or expects to pay. When he decides or thinking of payment, it becomes a payment to the customer or to the other parties that purchase the entity's goods or services from the customer. That is the end customer or customer's customer. So that is the consideration payable. The consideration payable to a customer also include credit or other items. You can give some refunds or coupon or voucher or so many options that can be applied against. That means if it is a coupon or voucher, it goes and applied against the payment to the entity. So this is the payment. So to simplify that, I am going to simplify that today. Payments to the customer, you can categorize this as 2 categories. The standard says payments to the customers reduce the transaction price. That means reduce the revenue. Because this revenue manipulation is a big headache for ISB. That's what they formed this standard SLFRS 15. So many manipulation for revenue. They inflate, deflate, they do everything. The manipulation happens. So the payments to the customer, the standard says reduce from the transaction price. Unless the goods and services supplied by the customer to the entity is distinct and the fair value of the goods could be reasonably estimated. The fair value should be reasonably estimated. So we can categorize into two. One category, whatever the payment, you reduce the transaction price. That means reduce the revenue. When you reduce the transaction price, that means your revenue is reduced. That's the main component. Then the other category is treat it as a separate purchase. Yes. In my examples of computer manufacturer and the motherboard supplier, if the motherboards can be separately identified and the fair value can be identifiable, then treat it as a separate transaction. That means a purchase from a supplier. No problem. But in case, if the fair value of the goods and services supplied by the customer to the entity is less than the consideration paid by the entity. You pay $1,000, the fair value will be $600. They have inflated the price. Due to various factors, is the trade transaction. They inflate this way, that way. Because the supplier also will inflate his price. That means the entity also will inflate his price. The supplier, the customer will also inflate his price. So the standard is careful. There is no revenue manipulation. So what the standard says is, if the fair value of goods and services supplied by the customer to the entity are less than the consideration paid, that means you have paid more than the fair value, then the excess should go against the reduction of transaction price. The excess should go. Okay. If there is no fair value, you can't estimate the fair value. Still there is a supply comes in. Then the whole consideration, whatever is paid to the customer, has to be set against the revenue or reduce the transaction price. This is the simple explanation about this payment to the customer. So the next point comes in as, okay, we are going to reduce this transaction price. When we can do this? When can we recognize? Though the standard says the later of two incidents or two events. Later of two events. Later date. What are the events? When you recognize revenue of transfer of goods and services. That means when you are satisfying the performance obligation and recognizing revenue, at that instant you can reduce the transaction price. Or when the entity pays or promise, even if the payment is conditional on the future event. There can be a future event, occurrence or non-occurrence can affect the payment. Even then, if you have paid it or you have promised it, then you have to reduce the transaction price at that date, whichever is later. For example, if this happens on 1st January and this happens on 12th January, you take the 12th January, the later date. The promise means it can be as implied. How can it be implied? It is understood from the past business practices, the customary business practices of the entity. Issuing coupons, if it is a past practice, then the promise, okay, if the entity says, no, I will give you coupons, then that's a promise. So that's all about this payment to the customer. It is very much simplified. Now I am going to handle one or two examples which will make you understand how it is practically done. So we will see those things. Okay, now we will see a small example. Consumer goods manufacturer M enters into a 1-year contract with retailer R to sell the goods. He is going to sell the goods to the retailer R for 1 year. It's a contract. So the retailer R commits to buy at least $1,500 worth of goods. So he is promising, okay, within this 1 year, I will buy minimum $1,500 worth of goods from you. So what happens? The manufacturer M also makes a non-refundable payment. He is giving $15 to the retailer to improve his shelving, to place his goods. But the shelving is not controlled by M. It's controlled by R. That means the M decides, okay, this is not a payment against distinct goods or services because I am not getting the control. I will treat it as a reduction in transaction price. This is how it happens. So it is not a payment against distinct goods or services because the shelf is ours, our own the shelves. He is only giving some help to improve the shelves to accommodate his goods. So it is a reduction, he is treating it as a reduction in transaction price. That means a reduction in revenue. So we will see another example. Okay, here is another simple example. Vendor A sells to a customer B $10,000 worth of goods. He also pays, in addition, $1,000 for a service provided by the customer. Maybe a transport service or agency service or whatever it is. Advertising service, something like that. So he is providing a service and he has paid 1,000. Suppose he can estimate the fair value of the service is 600. Then the excess is 400. He has paid 400 extra. That 400 will get reduced against this transaction price. So you might ask what will happen to the 600. You treat it, it is a distinct service, no? So you treat it as a service charge. Debit your expenses and debit your expenses 600, debit the revenue 400 and credit your bank when you are paying the 1,000. So the revenue will be reduced by 400. So the net revenue will be $10,000 minus 400 is 9,600. The transaction price will become 9,600. In case if he can't estimate the fair value reasonably, what will happen? The transaction price will be reduced by the whole $1,000 what he has paid for the service, and you have to recognize the revenue $9,000. Why? It's very simple. Now I have simplified and it's very simple. Don't get confused with the wordings, all that. So I hope this video would have helped you to understand this principle, and I hope you have enjoyed my video this weekend. So with this I am concluding the determination of transaction price step 3. Now I will get back to step 1, 2 and 4, 5 in my next videos. So we will meet again. Until then, take care. Good luck.